Banking conditions in the Ninth Federal Reserve District improved in 2012, and we're forecasting in 2013 that they'll improve again. My name is Ron Feldman. I'm the head of Supervision, Regulation, and Credit at the Federal Reserve Bank of Minneapolis, which oversees banks and bank holding companies in the Ninth District. And today I'm going to talk about our forecast for banking conditions in 2012. How did those perform? And I'm also going to talk about our forecast for 2013. So before we get started with the forecast, let me give you a little bit of background on the Ninth District. So the Ninth District consists of the states of Montana, North and South Dakota, Minnesota, the Upper Peninsula of Michigan, and the western portion of Wisconsin. In terms of 2012, we made a forecast roughly a year ago for what conditions would be like at the end of 2012, and those forecasts were pretty solid. So the variables that we forecast, and I'll talk about what they are, came in pretty much in line with what we said they would. So what do we forecast? We forecast three things. First, we forecast for the median bank in the states in our district, the profitability. That's going to be measured by the return on average assets. We forecast loan growth. So that's the change in loans on banks' balance sheet 1 year to the next. And we forecast the level of problem assets. So these are loans, for example, that are not paying on time and in full relative to the financial resources that banks have to absorb those losses. So we're going to forecast all three of those for all of the states that I just mentioned previously that are in the Ninth District. And again, the forecast for 2012 was on target. So what kind of year was 2012? Well, it was a middling to strong year in terms of banking conditions relative to the improvement that they had. And let me talk about these in a little more detail. First, in terms of profitability, we saw strong gains, and that's obviously on the plus side. But there's a little bit of context here. So first, the gains did not come from the normal source of profits for banks in our district. So normally banks in our district make money by what's called the net interest margin. That's really the difference on the income they get from the assets they hold. So for example, the interest they earn on loans minus the cost of raising funds, like the cost on deposits. So it's the difference between what they earn and what they pay. And that's the margin that they get to keep. That actually went down in some of the states, for example, Minnesota. So how did banks have strong profitability? Basically, they're putting less money aside to absorb future losses. Now that's entirely reasonable because conditions are improving, but it's not really a sustainable source of earnings going forward. So yes, there was improvement, but maybe not from a very sustainable source. The second bit of context for profitability is that while it improved, it's still below the long-run median. Now let's turn to loan growth. Loan growth was also pretty strong across most of the states in the district. Here, I think the main point I would make is that while it's improving at a strong clip, it's still a little bit away, and certainly further away than profitability, from the long-run medians. Finally, problem assets. Now here's the real strongest area for the district in terms of performance. Problem assets are at very low levels for almost all the states in which we have oversight. In fact, they're so low that in states like North Dakota, they're at all-time record levels, certainly relative to the last 20 years. For example, the state of Montana. So the line is showing you the performance of the median bank in Montana. The dark line cutting across is the 20-year median. And then you're seeing on the right axis the forecast that we made as of last year. And you can see that profitability is at the very bottom end of the forecast range. So again, some improvement, but you can see it's still off of the 20-year median. How about loan growth? Here you can see even stronger gains, but even with the stronger gains, it was a ways off of the 20-year median, but within the forecast range. Now, in contrast, if you look at the graph on problem assets, you can see that it's actually below the black line. In this case, below means better than. So there's less problem assets today than there are relative to the 20-year median. So let me summarize the year in 2012. Strong improvements, middling improvements for problem assets, but really a strong year, but in many cases still off of the 20-year median. There is some variation among the states. And in particular, the Dakotas had a very strong year. Here, you're going to look at a graph of loan growth in the Dakotas, and you can see that it's just much stronger than it is for the district as a whole. And really, that's true for almost all the areas in the Dakotas. Profitability, loan growth, problem assets, they're really doing better than the rest of the district. Now let's turn to 2013. Before I do so, I want to give some caveats about and explain a little more detail how we do our forecasts. And you can see from this slide I provide a variety of caveats, but there's only two that I'm going to emphasize. One is when you're forecasting banking conditions, you're forecasting variables that just have inherent uncertainty. So what do I mean by that? I just mean that there's a lot of variance in these numbers. They go up, they go down, they change a lot. And when you're trying to forecast something, a moving target is obviously harder to forecast than data that stays the same. Another caveat is that we're coming out of a recovery. And typically you would expect the problem assets, profitability, loan growth to sort of fall back to the long run normal. But what if we're in a new normal? What if coming out of the crisis we're not going to return to what was normal previously? Well, we really don't know that now, and that makes forecasting a bit of a challenge. So what kind of forecast do we use? We use what's called a judgmental forecast. So we use actual statistical models, but we don't rely on them exclusively. We look at accounting data, we talk to bankers, and we just bring all that information together as a judgment. And again, the forecast we're making is for the median bank across the three variables I mentioned 1 year from now. So this is a forecast for what we think things are going to look like at the end of 2013. So what is our forecast? Our forecast is in some ways a little bit like what we saw last year, but maybe not as strong. So first let's talk about profitability. So profitability I'm expecting to improve, but not as much as it did last year. Now why is that? Well, I mentioned that the normal source of profits, the net interest margin, was actually sort of weak for some of the states in the district. That is going to, in my mind, be a drag on future profitability. So it's going to see some improvement, but not as much as we saw as last year. And I think we're going to get a little bit closer to the long run norm, but we're not going to make our way back to it. How about loan growth? Loan growth, again, I'm expecting to see a steady clip of improvement, but not as much as we saw last year. Again, why are we going to see not as much as last year? Well, last year we saw some very large increases. And while we're not back to the long run norm, we're getting closer. And as we get closer, I think the rate of improvement is just going to be a little less. And of course, there's going to be variation among the states. We've got some states that are having huge loan growth. They're probably going to slow down a little bit. Other states that are further away and have had slower loan growth, I think they're going to have maybe larger improvement. What about problem assets? Well, I'm expecting some decline of problem assets, but certainly less than what we've seen over the last year. Now, why is that? Well, we've seen such large gains in improvements in problem assets that in many cases we're actually below historical levels, and we just have less room to go. And that's particularly true in areas like the Dakotas where we're at certainly beyond 20-year lows. So what that means is that there could be some improvement, but there could also be some staying where we are now. Now that wouldn't be bad because we're at such strong levels, but it just means the level of improvement is likely to be low. And then finally, I think it's worth stressing that there's going to be some variation across the states and specific metrics as well. Some metrics in some states are just further off where they are normally. We're going to see more growth there. Some states are doing better than they've ever done before. There might be some improvement, but it's a little bit harder to keep improving at a strong rate when you've already done so for so many years. So I've described the forecast in general, and again, let me give you a specific forecast so you can see what I mean. And we're again going to use the state of Montana. So the far left bar, the vertical bar you're looking at, is for profitability, and it's the distribution of all profitability on a quarterly basis for the last 20 years. The box is the forecast range that we have for Montana, and the dot below the box is the current value. So what you can see is that I'm expecting the dot to move up closer to the 25th percentile for the median bank in Montana. In contrast, if you look to the far right, the purple area, you can see that because the problem asset levels are already below the median for problem assets, we're actually forecasting at least some chance that Montana problem assets remain at their current level. So again, it's consistent with the information I just provided. Less improvement in problem assets, more improvement around profitability and loan growth. Now let's turn to three graphs showing you the forecast, the same forecast for Montana, but in a time series manner. First, you're going to look at the profitability, and you can see that we're expecting some improvement, but still below the 20-year median. Again, for loan growth, we're expecting some improvement, getting a little bit closer to the median, but still off of it. And in contrast, if you look at the problem asset forecast, you can see that it's going to be some improvement, but maybe even a chance of staying where we are. In summary, we thought that 2012 was a middling to strong year, consistent with our forecast. 2013, some improvement, but less so than 2012. Thank you.